Are you curious about the strategy top investors use to reach their financial goals? Then you should know about dollar cost averaging, the most popular approach used by beginners and even the world's most successful investors. With this method, you invest automatically, consistently, and without stress. In this video, you'll discover exactly how it works. Welcome to AI Explains Investing. It's great to have you back for another video. On this channel, you'll find clear and informative content covering financial markets, investment strategies, and other key concepts every investor should understand. Tailored for both beginner and experienced investors looking to deepen their financial knowledge and sharpen their decision-making. Enjoying the content? Like the video, subscribe, and hit the notification button so you won't miss the next one. A quick disclaimer: I am not a financial advisor. The content in these videos is intended for educational and informational purposes only. Always do your own research and consult a licensed financial professional before making any investment decisions. Dollar cost averaging, or DCA, is a strategy where you invest step by step. Instead of investing a large amount all at once, you choose to invest smaller amounts at fixed intervals. This could be daily, weekly, monthly, or whatever rhythm works best for you. What makes this method special is that you invest whether the market is going up or down. You buy when prices are high, but also when they are low. By doing this consistently, you build a position over time at an average price. And that's exactly the goal of DCA, to achieve the lowest possible average purchase price. Because when the market eventually goes up, and historically the market has always risen in the long run, you will benefit from that growth. Why do so many investors choose this strategy? Simple. First, you benefit from lower prices when the market faces a dip. Second, you take emotions out of the equation because the fixed schedule determines when you invest, not your feelings. And third, you can start with any amount, even just a few dollars a month. But keep in mind, DCA is not a strategy to get rich quickly. It works best over the long term. And in a market that only goes up, a single large investment at the start may sometimes yield better results. That said, DCA is a smart way to start slowly, spread risk, and build your financial future, step by step. To make this even clearer, we'll walk through a concrete example of how this strategy works in practice. Let's take a look at how dollar cost averaging might work for you in practice. Imagine you decide to invest $500 every month throughout 2024, 12 times the same amount month after month, no matter what the market is doing. In the example shown in this video, you end up buying a total of 49 shares, and that's at an average purchase price of $124 per share. Sometimes you bought more because the price was low, other times a bit less when prices were higher. Exactly how DCA is designed to work. Fast forward to April 2025. The price has risen to $160. With 49 shares, your investment is now worth $7,840. Since you invested $6,000 in total, that's a profit of $1,725, simply by sticking to your monthly plan. And the best part? You didn't have to constantly watch the market. No stress, no timing. Just the discipline to invest consistently. That's the power of DCA. You steadily build wealth while the market does the rest. And that's it. This video has come to an end. I hope you found it valuable and that it brought you one step closer to understanding the world of investing just a little bit better. If you learned something new today, I'd love to see you back in the next video. There's always more to discover, and we're just getting started. Don't forget to subscribe to the channel and like the video if you haven't already. It really helps the channel grow and allows me to keep bringing you high-quality investing content. Thanks for watching, and see you in the next one, right here on AI Explains Investing.